index, and we've had the crossover here and the predicted differences, and they have started to move up, indicating that they are less weak than they were before, but not at this point indicating or signaling that we need to take a long position. In fact, in this particular case, if you looked at what was going on with the market, you could say, okay, we had this low right here, September 16th, and that September 16th predicted low was at 137.66. Since it's a re-entry, since our predominant trend is down, the blue line is there, we could say our criteria there will be if it drops 100 points below that predicted low, then we would re-enter, we would resell. We don't think that a market normally when it goes sharply down is going to make a V-top and immediately bounce back up. It takes some time. Usually it has to filter that out, and then it has made the decision that it's going to go back down, and so we would want to be back in the market as a short position at 136.66, and that would put us in the market again right here to ride the short position. Again, as you look at this, you can see there are some other spots in here where there are some decisions that have to be made. Sometimes if you are using the market's money, it makes it a lot more easy to kind of stretch your limits of risk. You don't want to have your own money right out of the box at risk, but you can take a few more chances if you are using the market's money to attempt to get in a position. Now, just to pick up a little bit more on where we're at here, we had the October 4th talked about earlier. The predicted high there was 133.12. When you put 2 cents or 200 pips on top of that, that means you're a buyer at 135.12. And so, it doesn't happen immediately again, but it does occur, somewhere right in the vicinity right here, 135.12. You are long as that candle moves up and ready for a long position, because now you have seen a little more evidence that the trend is going to go up, that the bottom has been reached, and it is starting to move back up towards the upside. Now, the question here, of course, is with all the news, with all the events, with everything going on, with all the drama and so forth, do you want to be long? It's probably not a comfortable position to take. Preferably, you'd want to be on the short side, but once the market has gone down, has given, kind of some satisfaction that it has reached the low and has bounced back up, then you feel that you can take, at least on a short-term basis, a long position and try to ride that up, as much as it is possible. How much it's going to give you, nobody can say, because this could be a fairly short ride. You can see where the market did, hit that low there, drop below there, might have stopped you out. Erring on the side of caution, you might have been out sitting there, and you might see, well, there's that October 7th candle, thinking that if you were long, hey, what a great bonanza that was. Well, you may not have caught that one. If you use a little judgment, a little common sense, you may not have been aboard for that particular one. If you then follow through with what that candle is going to tell you and look at the time frame, October 31st, we talk about this big candle here, this big sharp move there. It established a predicted low on that candle at 140.73. That was the reading for that day. If it would drop 200 points, 2 cents below that level, then you might say, okay, then I'm going to resume short. And to be a lot more comfortable being short, at least in my mind, I've got to think about, try not to sometimes let all that news and all that stuff come in, but you've got to remember that with everything that was going on, you almost had the sense that this thing was going to drop back again, that it was overreacting to the upside, got too extreme in that little short little shot up on October 27th, and it was now due to settle back, which it did. And if it dropped back that 200 basis points that we talked about, then we could go short, because that could indicate a more severe return to the downside. And of course, that is what happened. We would sell below that predicted low of 140.73, 200 basis points below that, and would be short at 138.73. And you want to then, once you are short, you want to make sure that you move your stop. You initially will have it only 1 cent above your entry point, and that entry point was in this vicinity right in here at 138.73, somewhere right in there, or 139.73 rather. And then you have to kind of gauge what is going on in the market. You want to move your stop then to above the lowest predicted high. And the lowest predicted high, if it bounces back up through there, then of course you want to be out, because in the market, the way it's going now, and the volatile action, and the, all the ramifications of the currencies not very well in set in place. Take your profit. Don't try to fight it. Don't try to end up with a situation where you can be exposed to the big loss situation, and clearly don't want to have that happen to you. Now, this is the euro. Let's take a quick look at what is going on with the U.S. dollar index. You can see that in the case of the U.S. dollar index, we don't have the predicted highs and lows on there. We'll take a look at a couple of the other things first. If we're looking at it from the standpoint of a traditional technical analyst, which most people are, you can see that, of course, we had the trend up, and again, where you follow that blue line, look at that predicted moving average compared to the actual moving average. That is would like to be on. We had the crossover here where the market moved above, the predicted moving average moved above the actual. Even before the actual started to turn, you can see it also, in this case, it then moved above what was going on with the previous highs that we had. The highs right here were was another good clue that here was a situation that we could take advantage of if the market were able to give us a good situation. Okay, when we then want to look at the other indicators that we have here, we have some traditional things that we would like to look at. We would like to look at the common things that people look at. For example, we look at dojis. You can see we have several dojis that occur here. The doji is a market opens up, trades down, closes at roughly the same level as it opened. And you can see we had dojis all along the way here. Each one of those represents a potential turning point, uncertainty, and as long as that predicted moving average stays above the actual, you could stay in that position for a while, but be alert to the fact that the dojis could suggest a change in the trend. One other point here, we're going to remove some of the indicators we have on here, but one other point to make here in regard to what this market had to offer is that we had the price moving higher, constantly moving higher, but look at the predicted differences moving down. That's divergence. Momentum was moving down. The move up, it still went up in price, but it was a weaker rise. There was more weakness that was occurring in the trend than was indicated by the price itself, because the price went on to move up, but the divergence means the trend was just less strong. It doesn't mean that it was necessarily a real weak, but less strong than it had been. And so you can then use that as kind of a clue underlying the market, what is going on to the market, because something is stirring and something is likely to turn.